So I do believe that actually, given the rise of debts, private and public, we are in what economists call a debt trap. In advanced economies, it's 420% of GDP and rising. In China, it's 330% of GDP and rising. So my concern is that we are in a debt trap.
In the clutches of a debt-laden labyrinth, Nouriel Roubini's haunting words reverberate, casting a foreboding shadow over the fragile foundations of our financial existence.
Stocks of private and public debt, private being debt of households, corporates and financial institutions, public is central and local governments, have been increasing decade after decade.
As the relentless jaws of the debt trap tighten their grip, Roubini's piercing voice pierces through the haze of illusion, exposing the dire consequences of our insatiable appetite for borrowing, plunging us deeper into an inescapable quagmire of economic despair.
Well, we're in a situation in which in normal times we're not reducing debts and deficits, while whenever there is a crisis, then we have to backstop the financial system. There is more buildup of public debt. There is more buildup of private debt because with zero policy rates or negative policy rates or quantitative easing and credit is cheap.
Fear and desperation intertwine as Roubini's dire warning echoes, a solemn reminder that we are but captives in a vicious cycle of debt, shackled to a system that thrives on our collective servitude and threatens to suffocate any glimmer of hope for financial freedom.
I do believe that this stagflationary crisis is going to emerge this year. The latest numbers on inflation coming from the US and Europe and other advanced economies show that the inflation now is quite sticky, both price and wage inflation. We still have a number of negative aggregate supply shocks.
The specter of indebtedness haunts our every step, fueled by Roubini's somber words, reminding us that the debt trap is an insidious adversary, devouring our resources, stifling innovation, and robbing future generations of the opportunities we squander.
So we have a mountain of debt and many institutions, some parts of the household sector, some parts of the business sector, some financial institutions, some governments, some entire countries are insolvent. Given their income, they're not going to be able to pay back their debts. I call them zombie institutions.
Amidst the wreckage of shattered dreams and broken promises, Roubini's cautionary tale reverberates, a clarion call to break free from the chains of debt, reclaim our autonomy, and forge a path towards a future unburdened by the weight of financial servitude.
So we are in a debt super cycle where both in good times and in bad times, debt ratios are rising, and therefore eventually central banks are in a trap. People said they're going to normalize policy rates, but with these levels of private and public debt, if they were trying to do that, there'll be a market crash, an economic crash, and therefore I think the path of least resistance, given that debt ratio, is going to be to wipe out the real value of nominal debt at fixed interest rates with higher inflation.
As the world teeters on the precipice of a debt-induced catastrophe, Roubini's somber warning serves as a rallying cry, urging us to break the chains of our own making, chart a course towards fiscal responsibility, and liberate ourselves from the clutches of the debt trap before it's too late.
Central banks are in a dilemma because they have to raise rates more to fight inflation. But if they do so, the economy is going to start to contract quite soon. And if they don't, then we could have a de-anchoring of inflation and inflation expectation. So I expect that we're going to have a recession in the US, in Europe, in other advanced economies at a time where inflation is not back to 2%.
Today, unfortunately, we have the increase in inflation rates. It's double-digit already in the United Kingdom and Europe. And central banks have to fight inflation by increasing interest rates, short-term interest rates, and that leads also to increase in long-term interest rates. So mortgage rates are rising, credit card interest rates are rising, auto loans, student loans, business loans, and so on and so on. So those institutions that could barely refinance themselves now are facing massively increasingly debt servicing at a time where the economy is contracting, we're entering a recession, and we have inflation. So it's about a triple whammy. 20 years ago, debt to GDP ratio globally was about 200% of GDP. Right now it's 360 and rising. In advanced economies, it's 420% of GDP and rising. In China, it's 330% of GDP and rising. So my concern is that we are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, the stock market, and the economy, and therefore they'll be in a debt trap and unable to normalize policy rates. That's why I see inflation ahead.
Well, the markets for now are not pricing in yet 6%. I think that the Fed funds rate will have to be certainly above 6% to achieve a 2% inflation target. But if you raise interest rates to 6%, then you're going to have a real hard landing. Then you'll have also a crash in financial markets. You'll have a severe correction of equity markets. You'll have bond yield going higher. You'll have the credit spreads for borrowing by the private sector rising. So you'll have a severe financial distress. That financial distress is going to make the recession more severe. And a more severe recession, by having a contraction of income and output, is going to increase the number of defaults by household, businesses, corporates, and even some financial institutions and some governments in poor countries that have serious debt problems. So there will be a kind of a negative feedback between a more severe economic contraction leading to a worse financial crash and a worse financial crash leading to a more severe economic contraction. That's where I believe that eventually the Fed and other central banks are going to wimp out and blink, because faced with increasing interest rates that causes both a hard landing and a financial crash.
In the UK and US and Europe, we're borrowing our own local currency. And if you had a bout of unexpected inflation, inflation can reduce the real value of nominal debt at fixed interest rates of long duration. But it's a tax. We're taxing creditors and savers to redistribute income and wealth to those who are borrowers and debtors. And it's a tax that actually is not even decided by a parliament or by a political government, but is decided by the central banks. So I do believe that actually, given the rise of debts, private and public, we are in what economists call a debt trap. There is so much private and public debt that there'll be an incentive to try to wipe it out with a bout of unexpected inflation. We don't want to raise taxes enough. We don't want to cut spending enough. So we're going to use the inflation tax to resolve this problem. It's a form of default, however. It's a capital levy on savers and creditors and all who hold public and private debt. We have a huge amount of debt and deficit. What are the options? Are we going to cut government spending? Politically, the pressure everywhere in the world is to do more spending to essentially deal with income and wealth inequality. Are we going to raise taxes on the wealthy and the rich? There's going to be constraints on that. So there'll be constraints that are going to imply the deficit remain high, and therefore the path of least resistance is going to be to monetize them and try to wipe out with higher inflation the real value of nominal fixed interest rate debt. Of course, over time, debt is going to reprice. Short-term debt is going to be higher interest rates. With high and volatile inflation risk premium are going to go higher. So that's going to be a solution in the short term. And eventually, high debt ratios with real rates rising over time is going to imply debt defaults, because there'll be unsustainable debt situation, both in the private sector and in the public sector in a number of countries. So I see both inflation and debt crisis ahead.
Well, in the 70s, when they wimped out, we had double-digit inflation. This time around, we might not get to double digits unless there is a major geopolitical shock. In the 70s, you had the war between Israel and Arab states and the Iranian Revolution that spiked oil prices. I think that markets are underestimating how this year maybe Israel may strike Iran, because Iran is becoming a threshold nuclear state. If that were to occur, and the flow of oil out of the Gulf is ample for a few months, then you could have oil prices going to $200 per barrel. You'll have a shock like in the 70s. But in the 70s, we had this stagflationary shock coming from oil that caused inflation and recession. But that ratio in advanced economies were only 100% of GDP. Today is 420% of GDP in private and public debt. So in this case, if we have those shocks to say oil prices, not only you get inflation, not only you get recession and stagflation, but you get what I call a great stagflationary debt crisis, because with interest rates so high, then debt ratios become unsustainable. Today, we have the worst of the 70s in terms of a variety of negative supply shocks. but debt ratio are even worse than after the global financial crisis, when we had the debt problem, but we did not have an inflation problem. So at that time, there was deflation or lowflation. Now we're facing the perfect storm: inflation, recession, stagflation, and a potential debt crisis.
Right before the COVID crisis, the Fed was writing reports on financial stability, pointing out the leverage of the corporate sector. Of course, high yield and fallen angels. But then during COVID, these folks should have gone bust, but they were bailed out. We bought even high yield debt, you remember, commercial paper, and everybody under the sun. So the zombies were bailed out. And the excesses of having leveraged loans, CLOs, Cov Light got even worse, and people got even more indebted. This time around, the party's over because the Fed, for now, will have to raise rates. Those debt service ratios are going to become impossible, and you get the double whammy for those corporates. You get a P&L because income is going to fall because of the recession, and you get a debt problem with debt servicing ratio rising, and therefore there'll be a corporate debt crisis, one we avoided during the GFC and during the COVID crisis.
Right.
First of all, the increase of inflation we've had in advanced economies like the UK, Europe, and US is driven in part by what people refer to as being bad policies, loose monetary, fiscal, and credit easing during the COVID crisis, too much for too long. But then we also had a series of negative aggregate supply shocks that reduced growth and increased the cost of production. The first one was the impact of COVID on production of goods and services, on the supply of labor, and on global supply chains. The second one was the impact of the Russian invasion of Ukraine on commodity prices, oil, natural gas, food, fertilizer, industrial metals. And three, the zero COVID policy of China has led to further global supply bottlenecks. So it's a combination of bad policy and bad luck. In the case of the UK, there was also a self-inflicted wound because the decision of Brexit reduces potential growth from about 2% to maybe 1.5%. It increases the cost of production. You have less migration, you have frictions in international trade, and therefore it's also a stagflationary process. So on the supply side, we have these shocks, but over the medium term, there are other shocks that are medium-term stagflationary. Deglobalization, reshoring of manufacturing to high-cost countries, friendshoring, aging of population, restriction to migration, decoupling between US and China, global climate change, pandemic, cyber warfare, weaponizing our currencies as a tools of national and foreign policy, a backlash against income and wealth inequality. These are all factors that are more medium-term. They're all stagflationary. They reduce potential growth, they increase the cost of production on the supply side. On the demand side, central banks are saying we're going to fight inflation at any cost, and we're going to go back to 2%. Well, we have on one side debt ratios that are unsustainable, and as I pointed out, the current mild stagflation, where growth is lower and inflation is higher, is not just driven by short-term supply bottlenecks, both in goods market and the labor market. I pointed out that I see over the medium term 9 negative supply shocks going to reduce potential growth and increase cost of production over time. Very briefly, what's going to happen is deglobalization and protectionism. We'll have balkanization of global supply chains, aging of population in advanced economy and emerging markets, restrictions to migration from south to north, decoupling between US and China on trade, technology, data, information. We'll have global climate change going to increase the cost of energy and the cost of food prices. We have pandemics going to disrupt again, global supply chains. We have also cyber warfare that's going to be a source of disruption of production. And finally, the rise in income and wealth inequality implies that there'll be monetary and fiscal policy trying to help workers, labor, unions, and that's going to put upward pressure on wages. So I see a situation which over the medium term, with loose monetary and fiscal and credit policy and these negative supply shocks, you could end up over the medium term in a situation of stagflation like in the 1970s. That's the situation I worry about. This time around, instead, is different because we have so much debt and central banks like the Fed have to increase interest rates to fight inflation. So the zombie institutions are going to go bankrupt. That's why not only we're going to have inflation and stagflation, but we'll have a stagflationary debt crisis. In the 70s, we had negative supply shock, 73, 79, but we had very low debt ratios. So we didn't have a debt crisis in advanced economies. We had one in Latin America. Argentina, Mexico, Brazil borrowed too much in the 70s. When Volcker jacked up interest rates to 20%, they went bankrupt. After the GFC, we had the debt problem, mortgage debt, housing debt, bank debt, and we had a debt crisis, but it was a negative aggregate demand shock, and therefore we had lowflation and deflation. Today, we have the worst of the 70s with a massive amount of stagflationary negative supply shock. Well, I think it's unappreciated because even those who worry about rising inflation make an argument that once these short-term bottlenecks are going to go away, the source of inflation is going to be essentially overheating of the economy coming from the fact that monetary, fiscal, and credit policy still too loose. I agree on that side that aggregate demand is going to be in overheating, but also worry about the medium-term aggregate supply of the economy. And I see these global trends that are just the reversal of the forces that for the last 30 years kept inflation low. All of them are reversing in a direction where potential growth is going to be lower, cost of production is going to be higher, and since monetary and fiscal policy and credit policy are going to be loose, eventually we end up with inflation and slower growth, thus stagflation.